Morning. Most of the reports that we go through, and they all quote that the sentiment indicators have dipped to the December 16 lows. That's the post demonetization lows. So looking in hindsight, would you say now is a good time to re-engage and get back into the markets, buy all that you always wanted to buy when it was looking expensive up until January?
See, I would think that the current phase is a test of allocation skills within equity. I think most people are still allocating money into equity exactly in the same way in which they allocated money in 2017, which does not fit in with a return to growth story that we are trying to spot here. If you are trying to spot a return to growth, then possibly the investment allocation within equity will have to change. I think that doesn't seem to be happening. It's like, suppose you're driving on an expressway at a very high speed, and then you're going to get into a city. You need to slow down and change your driving style. I think that investors are driving the same way into the city. That is something which has its price to be paid. I would think that people should actually change course gradually now. I'm not saying that you should not buy equity or anything like that, but I'm saying that the style that worked in 2017 may not work for the next 2 years.
So what is the right aptitude for the market at a time when you are seeing global uncertainty as well as domestic uncertainty? While part of the problem has got solved by, the respite coming in for bond yields because of the H1 borrowing plan, but you've got a big election as well coming up. State elections begin from next month, and then, of course, the big one in 2019 as well. Earnings also looking a little bit sketchy, though in part the revival has taken place already. So what is the right driving approach that one needs to adopt?
See, firstly, we need to understand that till the election issue is settled, you will have markets which will, by and large, remain tentative. So I don't see a high conviction phase for the next 1 year or so. So if it is not going to be a high conviction phase, I think that the markets actually afford us the luxury of building conviction in newer ideas, looking at themes or stocks which are maybe slightly more expensive now, but which can come into more favorable valuations over the next 1 year, and gradually building a newer set of ideas. I think that is what one should do. What we have seen in the last 2-3 months is money getting into the same themes, getting invested in the same stocks, protecting their valuations. I think that has overplayed itself. So I think that as an investor, I would gradually move out of stocks where the institutional imperatives are prevailing, where they are massaging NAVs or doing things which don't really add value to me, and look at things which will add value into the future. It is a bit of a long-term race, but it's something that should be run at a pace which is more gradual and steady. That is what I would think.
I completely agree with you that for a value investor, ultimately it's the price which matters, and it's the price of the business which will be important to determine your rate of return. But let's look at a classic example. 5 years ago, if you bought into an HDFC Bank, which 5 years ago was also expensive, versus ICICI Bank, ICICI Bank has not even given you market beating returns. A similar example here is that if you bought into Titan 5 years ago, even though it was an expensive stock, you've managed to hit a home run. So why do you think markets are disproportionately rewarding growth companies? Yes, the P multiples could be lofty, but that's where the price appreciation is.
I don't think that we can simplify that up to this for the simple reason that I think too much institutional money is hiding in these two stocks. And they have, in the case of HDFC, it has a disproportionate weightage in the indices. So whenever the indices fall, institutional investors are buying the stock to shore it up. So I think that all these excesses are built into the price of HDFC Bank. In the case of Titan also, I see that institutional imperatives are playing. I want to remind you that from the time of demonetization, it has been, I think, between 3 and 4 times it has appreciated. And I don't think the fundamentals have changed to the extent at which it should go 3 or 4 times. You have seen very large private investors actually express disappointments at several times during these past 15 months about the performance of the company, but the valuations have still run ahead. Titan is possibly discounting a lot of future good that it will benefit from, and it doesn't reflect any bad news in the stock price. Importantly, it does not reflect what would be the consumer behavior if there is a sharp spike in global gold prices. So I think that somewhere we are trying to simplify our assumptions based on the stock behavior in the last 1 or 2 years. The stock behavior has been driven by institutional imperatives. I think that is the most important point that I will remember with respect to stocks which have performed exceptionally well. I will look for signals of how much institutional imperatives are padded into their stock price. That is very, very important because these imperatives can change. We have to appreciate that the institutional investors are people who can be extremely fickle over the long term.
I just want to put out those P multiples because this has been a theme which I've been flagging off, that keep your return expectations diluted if you're buying into a Jubilant FoodWorks or a Titan or a Nestle. I mean, there is no way in the world you will make double-digit CAGR returns if you buy a Titan or a Jubilant FoodWorks or a Nestle at P multiples of 50, 60, 70. But Shyam, that is not my question. My question is, let's talk about some actionable stuff here. Right now, bond yields are at about 7.4 to 7.5%. Equity markets have seen a correction of 10% for the index and about 15-18% for small cap, small cap or mid cap NAV schemes. Where do you think one should now realign their asset allocation? Go for debt because there has been a sell-off in the bond market, go for mid cap because they've seen a sizable correction, or stick to large cap? They may have corrected less, but they could be the first one to bounce back.
See, I think broadly, I see a lot of opportunities in companies which are going to get assets which will give them growth. That is one thing. Like, the NCLT resolution of steel will probably give one or two big companies a very distinct edge to ramp up their earnings because we are going to close the markets a bit and growth is going to be there. So that is one place. Commodities in large cap may be a good idea. And if you see, those haven't fallen much in the current fall. If you see in the current fall, these stocks haven't fallen much despite institutional under ownership, which is very interesting. So I think that those are some of the stocks which one can look at. That's what I would think. And I think that, see, I'm basically a micro and a small cap investor looking to scale up new ideas. So I will very, very slowly buy my stocks. I'm not in any hurry to really deploy money. But I'm clearly getting out of mid caps, where the mutual funds are really running a circus.
Okay, so where is it within mid caps, or rather small caps, I should say, that you are hunting, or maybe not buying, or right away, as you said, but at least keeping on your radar? Any sectors or themes that in particular interest you?
In small cap, you cannot have much of thematic investing, but broadly, I will say that in companies which have a certain distinct, edge in terms of their technology or the ability to do what others cannot do, stuff like that. These are typically in spaces like chemicals, in consumer products, or in B2B, where they supply to consumer-facing companies, but there is something unique in what they supply. Typically, these are companies which are debt-free. So there are certain characteristics that I would look for in companies and try to pick them up. Yes, they are very highly risky, whether it is small or micro cap, but I'm used to doing it, and I'm used to also taking the temporary knock in those stock prices. So typically, I would expect that some of these stocks may lose 20 to 30%, maybe even more sometimes if the markets get more brutal. And that is something that one has to live with. So naming a stock at this point and somebody buying it and losing 30% and feeling bad about it is not a bright thing. But broadly, these are I like companies in the chemicals theme, in CRAMS, in consumer durables. These are some of the areas where I like ideas.
This could be interesting. So let's work with this disclosure, Shyam, that if a stock, what we are discussing, if markets go bad, could fall by 15, 20, even 30%. If somebody says, look, I can digest a 15, 20, 30% volatility, yet I'm ready to buy that stock, what would be that idea?
See, I would probably, if you say, I would buy some large cap companies in metals, in steel particularly. Ideas are evident, the stocks, the big ones. Those are completed capex, or where the acquisition decisions are already out in the open. Those are buys.
Any PSU bank, Shyam? I mean, PSU banks, currently are being beaten down as if they will cease to exist. And I keep on reminding everyone again and again that okay, these are not great businesses, but they still have 70% of the banking market share. They may be losing that on a daily basis, but the way markets have beaten these banks down, it's like making a case that after 2020 they will not exist.
Nikunj, I have been buying PSU Bank ETFs consistently, which are indexed. I have been buying them, but I have been allocating slowly because we don't know where it can go. So that is something that's not within our control. But as I have been repeatedly saying, I have been buying the PSU Bank ETF. Our averages are not very high compared to the current valuations of the ETF. So we would continue to follow that directional buying. We will not change. I am convinced that there is a trade in that, which will be a very swift and very profitable trade in PSU ETFs.